Warren Buffett's letter to his shareholders just came out. Let's analyze it and see what we can learn as stock market investors. Hey guys, welcome to my channel, Investing Untangled. Hope you're all doing well. On this channel, I post videos about stock market research, detailed business and stock analysis, and also educational content about stock market investing. And if this is something that interests you, then hit the subscribe button and the notification bell and follow my content here. In this video today, I'll talk about the key takeaways from Warren Buffett's recent letter to his shareholders. It just came out a few days ago. Warren Buffett is the CEO of Berkshire Hathaway, and he is by far the best investor in the world. And he discusses in these letters that he writes every year to his shareholders, he discusses the moves that he's making in the stock market, his current investments, and what they plan to do with Berkshire money. And these letters are full of stock market insights and wisdom, and they're very helpful for value investors like us. So without further ado, let's check out Warren Buffett's recent letter to his shareholders. And if you don't mind, please hit the like button. That supports my channel a lot. So let's get into it. Warren Buffett's annual letters always start with this comparison between Berkshire and S&P 500 index, and it tracks it all the way from 1965 to 2020. Here you can see I've highlighted the gains that Berkshire has had over these years. So it is a compounded annual gain of 20% versus the S&P 500 index, which resulted in a 10.2% annual return. So here you can see Berkshire has beaten S&P 500 by 10 percentage points over all these years. And if you would have invested money in 1964 in Berkshire Hathaway, you would have gained returns of 2.8 million% versus 23,000% in S&P 500 index. That shows you the mastery of stock market investing that Warren Buffett has. Here I'll now highlight the major takeaways from this annual letter. Buffett talks about the concept of retained earnings to start with that adds great value to a company and reflects over time in its share price. And what he means with that is that companies that retain their earnings and do not pay dividends out, they actually use those earnings to grow their business a lot. And since Berkshire owns partial stakes in many companies, the earnings of those companies are not entitled to be earnings of Berkshire. So here you see Warren says from an accounting standpoint, the earnings of these companies that Berkshire owns, that is not included in Berkshire's income. Instead, only what these investees pay us in dividends is recorded on our books. But here Warren says what's out of sight, however, should not be out of mind. These unrecorded retained earnings are usually building value, lots of value for Berkshire. And these companies use these funds to expand their business, make acquisitions, pay off debt, and often repurchase their own stock that increases the value. So this highlights the concept of retained earnings, and that is the reason why Berkshire has not paid out dividends thus far. Because they have the best capital allocator in the world, and he knows what he's doing and what he's buying and where he's allocating all this capital to get great returns. Warren also talked about the $11 billion write-down of Precision Castparts that he did, where he openly said that he did not do a good job in valuing the company. And this is where he talks about it. The final component in our GAAP figure, that ugly $11 billion write-down, is almost entirely the quantification of a mistake I made in 2016. That year, Berkshire purchased Precision Castparts, PCC, and I paid too much for the company. And he further goes on to say that I believe I was right in concluding that PCC would over time earn great returns on the net tangible assets deployed in its operations, but he says he was wrong in judging the average amount of future earnings. And consequently, he did not make a good calculation of the price that would have been suitable to pay for this business. So this highlights the point how important it is to estimate proper future earnings and then discount them back or discount the cash flows back to get to a good price which is reasonable to pay. And there are actually not a lot of investors out there that openly talk about their mistakes, but Warren, given his integrity and honesty in the business, he has been one of the very few investors out there who has openly talked about his mistakes in the past, and we get a chance to learn from those mistakes, and he totally explains where he went wrong. He also talks about the negative connotation that is associated with conglomerates, because Berkshire is actually a conglomerate because it owns many businesses. But he talks about how Berkshire actually differs from other conglomerates. So he says that one of the biggest problems with most of the conglomerates is that the best businesses do not want that they should be taken over. So most of the truly great businesses had no interest in having anyone take them over. Consequently, deal-hungry conglomerators had to focus on so-so companies that lacked important and durable competitive strengths. That was not a great pond to fish. And he further goes on to say that beyond that, as conglomerators dipped into this universe of mediocre businesses, they often found themselves required to pay staggering control premiums to snare their quarry. And he says often the tools for fostering the overvaluation of a conglomerate stock involved promotional techniques and imaginative accounting maneuvers that were at best deceptive and that sometimes crossed the line into fraud. When these tricks were successful, the conglomerate pushed its own stock to, say, 3x its business value in order to offer the target 2x its value. So what he means is that many of these conglomerates actually cross the line and can go up to doing accounting frauds in order to acquire companies and have them on their own books. And this is where he says Berkshire is different from other regular conglomerates because they own also non-controlling portions of wonderful businesses. And he says, it took me a while to wise up, but Charlie and also my 20-year struggle with the textile operation I inherited at Berkshire finally convinced me that owning a non-controlling portion of a wonderful business is more profitable, more enjoyable, and far less work than struggling with 100% of a marginal enterprise. And this is how he says Berkshire differs from other conglomerates that own companies wholly. Then he also goes on to talk about the most valuable Berkshire businesses. He says Berkshire's value resides in 4 major businesses. 3 are controlled wholly by Berkshire and 1 in which we have only a 5.4% interest. And he says all 4 are jewels. So the largest business that they have is the insurance operation, which for 53 years has been the core of Berkshire. And this is the reason why this is their best business. Berkshire enjoys $138 billion of insurance float, which means it's not funds that directly belong to Berkshire, but it's basically the premiums that have been paid for insurance policies and they go into Berkshire's accounts. And with that, they deploy that cash to buy bonds, stocks, or cash equivalents such as US Treasury bills. And this is how they keep growing the business with all this float money. The second and the third most valuable assets for Berkshire are BNSF, which is the Burlington Northern Santa Fe Railroad Company, and it is America's largest railroad measured by freight volume. And the third most valuable asset is their 5.4% ownership of Apple. The fourth one is their 91% ownership of Berkshire Hathaway Energy. So these are the assets that are basically generating tons of cash for Berkshire. Warren also goes on to talk about the power of share buybacks, and he has been a big proponent of share buybacks for a very long time. And here he talks about the share buybacks that Berkshire did recently. Last year, we demonstrated our enthusiasm for Berkshire's spread of properties by repurchasing the equivalent of 80,998 Class A shares, spending almost $25 billion in the process. That action increased your ownership in all of the Berkshire's businesses by 5.2% without requiring you to so much as touch your wallet. And this is why he has been such a big proponent of share buybacks, because it increases your ownership in the company, and if the company is doing well and you get to keep higher ownership of it, it is good for you in the long run. He also goes on to say that in no way do they think that Berkshire shares should be repurchased at simply any price. And he says, I emphasize that point because American CEOs have an embarrassing record of devoting more company funds to repurchases when prices have risen than when they have tanked. Our approach is exactly the reverse. And this is where he highlights the contrarian mindset that he has, which is very important for value investing. Meaning when the price tanks, that's when Berkshire makes repurchases, while this is not the same for other American companies. And this is what we should learn as value investors. When the stock price falls, that's the good time to get in. Rather than panicking and selling your stock, you should rather jump in and buy the company that you have researched. And here he talks about how Apple has also been doing share purchases and how Berkshire has actually gone to increase their stake in Apple because of those share purchases. Our cost for the stake was $36 billion. He's talking about Apple here. Since then, we have both enjoyed regular dividends averaging about $775 million annually. So this is the dividend amount that they got from Apple, and have also in 2020 pocketed an additional $11 billion by selling a small portion of our position. And despite that sale, Berkshire now owns 5.4% of Apple. To start with, they had 5.2% of Apple, and they even sold some, and now the stake is even higher. That's because Apple repurchased its own shares, and that basically increased the amount of Berkshire ownership of Apple. So this goes on to tell us that when we are researching companies, we should always be looking at companies for potential investments where the management is shareholder oriented, they are consistently buying back their shares, and they're doing that at a reasonable price. He also goes on to talk about their recent investments and the holdings Berkshire has. They recently purchased Chevron Corporation and Verizon Communications in the last 2 quarters. And I've done a full video on Berkshire's moves in the stock market and what we can learn from it. I'm linking that in the description below for you to check out. He also goes on to talk about how Berkshire runs its subsidiaries, the ones that they completely own. And this, he says, is one of the key principles behind their success. And that is, Berkshire's job is simply not to meddle with the company's success. When a business manufactures and distributes a non-essential consumer product, the customer is the boss, and after 100 years, the customer's message to Berkshire remains clear: don't mess with my candy. Here he's talking about their business See's Candy. So what he means with that is that they own a company, they buy a company, but they still retain the management and do not mess with the management and do not meddle with the company's business. He also goes on to talk about Geico, and this is how they have been operating Geico. Also, Geico has been a cash generating machine for them. He also touched on the power of American economics, and he says never bet against America. He's talking about some of the businesses that they own that started very small and then grew out really huge, like the Nebraska Furniture Mart that they own completely. So he says today many people forge similar miracles throughout the world, creating a spread of prosperity that benefits all of humanity. In its brief 232 years of existence, however, there has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. And so he says our unwavering conclusion is never bet against America. He also discusses his earlier career, his earlier partnerships and funds. Here he talks about when he was running a fund. He says by that year, virtually all of my own money and that of my wife as well had become invested alongside the funds of my many limited partners. Instead, as the general partner, I was compensated by my limited partners only after they secured returns above an annual threshold of 6%. And this is totally opposite to how mutual fund industry operates. So no matter what the returns are, the fee has to be paid to the manager. And this is not how Warren Buffett actually ran his partnership. That goes on to show the conviction that he had actually in his own ability to get great returns. He also touches upon investing, speculation, and diversification, and the importance of a long-term perspective in investing. He says that while Berkshire is value-oriented, there are tens of millions of other investors and speculators in the US and elsewhere that have a wide variety of equity choices to fit their tastes. They will find CEOs and market gurus with enticing ideas. If they want price targets, managed earnings, and stories, there is no lack of technicians that will confidently instruct them as to what some wiggles on a chart portend for a stock's next move. The calls for action will never stop. He also says productive assets such as farms, real estate, and yes, business ownership produce wealth, lots of it. Most owners of such properties will be rewarded. All that's required is the passage of time. So you have to have a long-term perspective. An inner calm, ample diversification, and a minimization of transactions and fee. Still, investors must never forget that their expenses are Wall Street's money, and unlike my monkey, Wall Streeters do not work for peanuts. So again, having a long-term perspective, an inner calm, and ample diversification. Generally, he doesn't talk about diversification, but he says that as long as there is enough, there shouldn't be too much of it, you should be good. And finally, he also talks about the companies that generally generate great returns are the ones that are low in capex. And here he says the best results occur at companies that require minimal assets to conduct high-margin businesses and offer goods or services that will expand their sales volume with only minor needs for additional capital. We, in fact, own a few of these exceptional businesses but they're relatively small and at best grow slowly. So the point is, look for companies where the capex and overhead costs and operating expenses are low. These companies shouldn't need a lot of money to keep going and keep running their business, while they should be generating great returns with whatever capital they're allocating. So these were all the major takeaways from this letter. As you see, there were very important lessons of value investing that are very fruitful for long-term investors like us. Warren Buffett's letters have been a great resource for stock market investors, and we can actually learn so much from this wealth of knowledge there. Let me know in the comments below if you have read some of his annual letters and what you liked about them. So that is pretty much all for this video. If you got some value out of it, please consider leaving a like and subscribe to this channel, Investing Untangled. I'll be bringing in more videos like this and also detailed stock market research analysis videos and stock and business analysis videos. So stay tuned to my channel. I'll see you in my next video.